So, Jim Lebenthal, here's what you got. So we've got rates going up, right? But at the same time we have rates going up, we have earnings expectations that are going up as well. That's what David Kostin's writing about today over at Goldman Sachs. They're raising their S&P 500 2021 EPS forecast to 181. You decide what multiple you want to put on that to get where you think we're going to go. He says in 6 months you got 4,100 on the S&P, 12 months 4,300. You use some words today in our notes that make me a little nervous. You say, quote, it's clear sailing for right now. Clear sailing for right now. Jim, I'm gonna put that up on the wall. I'm gonna bring that back up if I have to. I'm gonna have to bring that back up, baby.
Hey, Scotty, it was a composite sentence. I said it's clear sailing for now, but look out for higher interest rates and higher taxes. I mean, listen, it is clear sailing when you look at earnings, but let me be super clear so that when we come back to this, we know exactly what we're talking about. 1.5% on the 10-year, you've got a problem in the stock market, period. Why? Because take a look at the earnings yield. If you take an Apple, a Microsoft, a Facebook, a Google at 30 times earnings, that's a 3.3% earnings yield. That's right where it's supposed to be if the 10-year is 1%. If the 10-year is 1.5%, and you add the equity risk premium of about 2.5 percentage points, that gives you an earnings yield of 4%, which means the PE on those stocks should be 25, not 30. And that's a good 12% lower than we are now. That's not a crash, but it's a correction. So, yeah, it's clear sailing, but until you get to 1.5% on the 10-year, this market will go through a correction. That's the thing to look out for.
I don't know. Steph said embrace higher rates.
Yeah, I was just going to say, Jim, what if GDP comes in at 7% this year? What if earnings actually come in up 30% this year? That means that that rates are going up, as Scott said before, for the right reasons, because all of this stimulus, it takes a while to get into the system. It usually takes about 12 months. And so we're 11 months into this thing, and certainly some parts of the economy have benefited from the stimulus, but not all. And so you are going to see better growth rates. And I think that's what the bond market is telling you at this point. And all, by the way, I think it's also telling you that there's a little bit more inflation than we expected. I certainly expect more inflation. My portfolio is certainly positioned for more inflation ahead.
Steph, you and I normally see things eye to eye. Sometimes we differ, and here's where we differ right now. Is I think those growth rates are absolutely priced into the markets right now. I think that we're looking at S&P 500 operating earnings of 175 this year, 192 next year. That gives you about a 22.5 multiple on the market overall right now on this year's earnings. And what I'm saying to you is I think the market has priced in those growth rates that you're talking about. Now, look, from here, we're at 127 on the 10-year, okay? Well, it's still a ways to go to 1.5%, but I just don't think that we can justify the same multiple at 1.5% that we justified at 125.
Jim, you said
or a week ago it was 115, or 3 months ago it was 1%.